Welcome to the chapter on international finance. This chapter will introduce you to the key concepts of exchange rates, foreign exchange risk, and international financial markets. These topics are essential for understanding monetary interactions between countries. In this chapter, we will cover exchange rates, foreign exchange risk, and international financial markets. These concepts form the foundation of international finance and are crucial for first-year university students. Let's start with exchange rates. An exchange rate is the price of one country's currency in terms of another currency. We will also look at the different types of exchange rates and see an example calculation. An exchange rate is the price of one country's currency in terms of another currency. For example, if one United States dollar is equal to 0.85 euros, the exchange rate is 0.85 euros per USD. There are three main types of exchange rates. A fixed exchange rate ties the value of a currency to another major currency like the US dollar or gold. A floating exchange rate is determined by market forces of supply and demand. A pegged exchange rate is a hybrid where a currency's value is pegged to another currency but can fluctuate within a certain range. Suppose you're traveling from the USA to Europe. If the exchange rate is 1 USD equals 0.85 euro and you exchange $100, you will receive 85 euros. The calculation is 100 USD times 0.85 euro per USD, which equals 85 euro. Several factors influence exchange rates. Higher inflation in a country typically depreciates its currency. Higher interest rates offer lenders in an economy a higher return relative to other countries. Political stability and economic performance make a country more attractive to foreign investors. Lastly, speculation can also impact exchange rates if investors believe a currency will strengthen in the future. Next, let's discuss foreign exchange risk, also known as currency risk. This arises from the change in price of one currency against another. We will also explore the different types of foreign exchange risk and see an example calculation. Foreign exchange risk arises from the change in price of one currency against another. Whenever investors or companies have assets or business operations across national borders, they face currency risk if their positions are not hedged. There are three types of foreign exchange risk. Transaction risk is the risk of exchange rate fluctuations between the time a transaction is initiated and settled. Translation risk is the risk that a company's financial statements will be affected by changes in exchange rates. Economic risk is the risk that a company's market value will be affected by unexpected exchange rate fluctuations. Let's look at an example. A US-based company expects to receive 100,000 euros in 3 months. If the current exchange rate is 1 USD equals 0.85 euro, the expected revenue in USD is 100,000 euros divided by 0.85 euro per USD, which equals 117,647 USD. If the exchange rate changes to 1 USD equals 0.90 euro in 3 months, the revenue in USD would be 100,000 euros divided by 0.90 euro per USD, which equals 111,111 USD. This change results in a loss of $6,536 due to exchange rate fluctuation. Now, let's move on to international financial markets. These are platforms where international financial transactions take place. We will also discuss the components of international financial markets and see an example calculation. International financial markets are platforms where international financial transactions take place. These markets facilitate the buying and selling of financial instruments across borders. The components of international financial markets include the foreign exchange market, or Forex, which is the largest financial market in the world where currencies are traded. The international money market deals with short-term borrowing and lending with maturities of 1 year or less. The international capital market deals with long-term borrowing and lending, including bonds and equities. Lastly, the euro currency market is a market for currencies held in banks outside their country of origin. Let's look at an example. A U.S. investor wants to invest in a European company. They can use the international capital market to buy shares of the company listed on a European stock exchange. If the investor buys 10,000 euros worth of shares and the exchange rate is 1 USD equals 0.85 euro, the cost in USD is 10,000 euros divided by 0.85 euro per USD, which equals 11,765 USD. International financial markets are important for several reasons. They allow investors to diversify their portfolios by investing in foreign assets. These markets provide liquidity, allowing for the quick buying and selling of assets. They also facilitate the flow of capital, which can lead to economic growth and development. Understanding international finance is crucial for navigating the complexities of global financial interactions. Exchange rates, foreign exchange risk, and international financial markets are fundamental concepts that provide a foundation for further study in finance. By grasping these basics, students can better appreciate the dynamics of the global economy and make informed financial decisions. Thank you for watching this chapter on international finance. We hope you now have a better understanding of exchange rates, foreign exchange risk, and international financial markets. Stay tuned for more lessons in financial economics.